of all of these. So, starting with commodities, there is definitely an inflation protection angle to commodities, right? Because when prices go up, obviously commodity prices go up as well. And they have very low correlations with traditional assets. So that's good too. Especially when it comes to gold, and this was true in the 2008 financial crisis, that we saw that gold went up when the markets came down. Unfortunately, that didn't happen in 2020. Even gold went down in your 2020 crash. Only the dollar went up this time around. But what happened was that when the money printing was done and everything started going up, and there was very high inflation post the COVID lockdowns and everything, when things started opening up, the inflation just skyrocketed. So commodities started doing really well as well, right? So at that time, if you had commodities in your portfolio, you would have made high returns. And when I say high returns, another angle of this is that usually the trading is done through futures, and there's a lot of leverage there. So the leverage sort of, you can say, enhances the returns if it is positive, obviously. So I shouldn't use the word enhances then, because it could be loss as well. So I should say magnifies. The leverage magnifies returns. So that is your commodities. How does it happen? Well, depends on supply and demand, obviously, right? And if you really know what you're doing, majority of retail investors don't know what they're doing, and they lose a lot of money because they, of course, take exposures through derivatives as well, and they end up losing a lot of money. But institutions, and especially those institutions who are either producers or consumers of that commodity, right? So let's say if you're talking about oil, so you have companies like Aramco or ADNOC, which produce oil, or you have Exxon. So these guys probably know a lot more about the supply and demand. And then you have consumers like, let's say, airlines that need to buy oil, etc. Right? So these people, they are not speculators, and they will be able to have a much better idea about supply and demand. So if you, as an investment manager, as a portfolio manager, look at their actions, whether they are buying or selling, what are they doing, so you can get into an insight, you can get an insight into what is expected. Because if these changes are happening, whether they're happening to supply, such as OPEC cutting down the production, or demand going up for whatever reason, maybe China is opening up and the demand for oil is going up. So if that change is happening, the price volatility could be very sharp. And let me remind you that these are traded through leveraged instruments, so that volatility could then further get magnified, and it could result in extreme volatility. So that could be very good if you're on the right side of it, right? And it could be very bad, as it is with many retail investors within this space. So their loss is a potential gain for a lot of institutions. Right. So, of course, therefore, commodities are attractive to investors. But not only for this potential profits, but also for diversification, right? Because of the low correlation, and also for the inflation hedge. So these 2 points we have discussed already. Now coming to farmland and timberland, similar to commodities in some ways, different in some ways. First of all, obviously, major risk here is the weather, because see, the commodity hasn't been produced yet. This is one stage before that you're at the farm stage, right? And you're trying to produce that commodity. It's not in that safe storage as yet, right? And if the weather is bad, there's flooding, there's a drought, your yield could be terribly reduced. So here, that sensitivity is there. Also, it's not just your local economy that you're exposed to. Unlike real estate, which, if let's say you're buying in Manhattan, something is happening in Hong Kong, it's not going to impact the Manhattan real estate. But if you're investing in, let's say, cotton in the US, well, if something happens in the global cotton demand, well, your business going to be impacted. So it's impacted by global factors, right? Unlike your real estate, which is just local factors. And the smoothing of the returns. So what happens, and this is a real estate problem in general, because the transaction data is not that frequent, right? So they are traded infrequently. So we don't really find out whether the price is actually like this. What we see is that, oh, this is the price, and we think it's very smooth. Actually, it's not smooth. It's probably like that, but we don't see it because the appraisal data is not that frequent, and we kind of just draw a straight line through it. So it appears to be less volatile, but in reality, it's probably not, right? But the smoothing happens. So you need to just be aware of that. And for the exam, and of course in your life as well, if you're investing in these assets, the risk could be more than you think. Of course, the ESG angle cannot be ignored, especially in today's world where this is becoming a bigger and bigger thing. These assets added to your portfolio can definitely improve your sustainability. And of course, they give you that diversification benefit similar to commodities. So in this way, they are similar to commodities. So that is it for this learning module. We saw this exhibit before as well. I think the important things to remember here are biological growth is there in timberland, which is different. And timberland, what else is different? You have TMOs over here, which you don't have in the rest of them. Phase in timber production, that is also different. Quality of timber, that is different, right? And what else? Everything else is pretty much the same. Again, lumber prices is something that you can play around with. You can't do that with farmland because you can't control the timing. When it's ripe, has to be sold. What else? Timberland provides income stream, but can also be thought of as a store of value, and you can play around with the price. You can't do that with farmland because it doesn't provide you that flexibility of production. We already discussed this. They are both, however, considered sustainable investments. Now, with commodities, you are mostly working through derivatives because the physical storage is complicated and costly, and the physical storage is not what you're doing. You're dealing in futures, and futures will give you return in terms of price changes. They also have inflation hedge potential, right? Because they are highly correlated with inflation, so that's good. They also give you diversification benefit, so that is good too. And this is something you get from your farmland and timberland as well, right? They also give you diversification benefit, but they are more risky when it comes to weather related threats because this is one step before commodities, right? Commodities, once produced, can be safely stored. But farmland and timberland is in an open space. It is more exposed to adverse weather conditions. Both of them, of course, offer sustainability benefits and diversification benefits as well. They both offer you commodities as well as farmland / timberland offer you diversification.